Hello and welcome to All Talk. Today we have here with us Bhavdeep Bhatt, who is the CEO of Northern Arc Investment Managers. Hello, sir. Pleasure to have you on the show.
Thanks.
So, Bhavdeep, I want to start by asking you that category 1 and 2 AIF. So, in that, private equity funds and venture capital funds give returns up to 18 to 20%, which is lesser than the equity returns as of now. So, why do you think the investors should look at this unlisted space?
Yeah. So I think first of all, it's a myth that equity kind of gives more than 18-20% return over a long period of time. If you just look at since inception, Nifty would have given close to 12%, 12.5% kind of return. Sensex, a similar kind of range. So I think and we just discussed in the session, last session, that the risk premium that you have really seen Nifty delivering over bonds, for example, over a long period of time is just about 3-4%. So let me just put it this way, that if you look at last 3 years of any CIO return in terms of annual outlook, they would have said that equity investors should expect return in the range of 10 to 12%. Okay. Now, of course, equity has kind of rewarded much higher than that over the last 3 years. But the point is, the expected return is not necessarily 18-20% plus. So I think the segment of private debt, private equity, particularly private debt, the segment which we operate in, we've been able to deliver like 14.57% gross return over the last 10-year period without any delay, without any delinquency to our investors, with a 1% kind of monthly yield, you can say. Every quarter we kind of pay 3% coupon to investors, and this is a track record that we have been able to uphold over the last 10-year period. So every quarter we have seen COVID, we have seen ILFS crisis, we have seen demonetization, and through all these ups and downs, we have been able to deliver that kind of return. So if any private debt is offering any 14-15% kind of gross return, I think it is kind of doing better than long-term equity return in the marketplace. Of course, the volatility of equity is very different, and the risk involved in private debt is very different. But having said that, the entire unlisted space, whether it's equity or fixed income, are quite competitive and compare quite favorably with equities long-term returns over a period of time.
So, equity PMS and category 3 AIF are similar to mutual funds. Then, why do you think the investors should look at AIF and PMS for their diversity of the portfolio?
Yeah, so category 3 as an asset class is kind of allows a lot of flexibility to investors, to the fund managers, and therefore the kind of return potential that category 3 offers is very different than the mutual funds offer, right? For example, we run category 3 money market alpha fund, right? So this is a fund wherein we kind of give intermittent liquidity once in a month. But the premium that investors have got over the last 5.5 years that we have been running this fund is 9.5% return over, say, typically 7.5% sort of return that money market mutual fund would have given. Now, why that is possible is because there is a little bit of flexibility that is allowed to us. It's a credit money market alpha fund that we have been running. And investors are quite okay. They can invest on any day. Minimum investment horizon that they need to have is 1.5, 2 months, which in any case they have for money market investments. So I think it allows a lot of flexibility to investors. So, besides what I just mentioned about our money market fund, I mean, funds can take leverage to a particular extent. They can use, there is a use of derivatives in category 3. These are the flexibilities which are not available in mutual fund industry. So to that extent, they are fundamentally different. And this is essentially for investors who have higher investment threshold in terms of minimum investment amount, as well as higher return expectations. So AIF is essentially for high risk, high return investors, whereas mutual fund is more for retail investors who are expecting moderate returns over a long period of time.
What are some popular strategies of category 3 AIF and PMS?
So in AIF, let me put it this way, that in AIF, as an industry, the composition of the asset classes changed. For example, private equity was like 77% of overall AIF AUM just about 5 years back. As we speak right now, that has come down to 44%. Private debt as a category was only 5% of the AUM in AIF industry. Now it has become 16%. So this is one of the fastest growing space, private debt, in the entire AIF universe, category 1, category 2, and category 3. Popular strategies point of view, I think there are a lot of innovations possible globally. They mentioned that, I heard someone say that there are 30,000 hedge fund strategies effectively which are launched globally, right? And a lot of those strategies can come to India over a period of time as the markets mature, as the liquidity improves on the fixed income side, as well as on the micro cap equity side. So I think there are a lot of possibilities in terms of innovative hedge fund strategies to launch on AIF 1, 2, and 3 category, particularly in category 3, because leverage is allowed there, use of derivatives is allowed there. And I'm sure both on equity and fixed income, there are a lot more possibilities in category 3. That's one category I think which has undergrown its potential as we speak right now.
Okay. And my last question to you is that there are so many categories and strategies in PMS, AIF. So, how does a wealth manager shortlist them for their clients?
Yeah, so I think most important part, it has to be client centric in terms of the distributor has to figure out what are the needs of the customers, and it's not enough that customers have more money. They need to really have the right risk appetite and the right mindset for the risk that they are underwriting, right? So of course there are larger the number of products, more are the building blocks to create the asset allocation portfolio for the customers, right? It's very important for distributors, I mean, and they would know as asset allocators to kind of understand clients requirements. But where does it fit in? I would say that any investor who has net worth of more than $1 million now in India should have at least 15-20% of the portfolio investment in AIF strategies. At least essentially 2 or 3 AIF instruments that two instruments I would say that I'm talking about. And yeah, I mean, they can look at multiple strategies within that, whether it's equity, fixed income, hybrid strategies, etc. And I'm sure, I mean, as we speak, in any case, last 10 years, AIF industry has grown from 0 to 10 lakh crore. Right now, industry is like 12 lakh crore. Mutual fund industry took 30 years to reach 10 lakh crore. AIF industry has grown this, covered the same distance in just 10 years time. That's how fast the AIF industry is growing. And we believe that that will continue to grow with more and more HNIs kind of coming into the industry. And if you just look at the domestic pool of capital available for investment in whether it's equity or AIF, equity or mutual fund or any other fixed income strategy, that keeps growing. If and lot of SIP investors over the last 15-20 years have become HNIs, and they typically would become the target segment for AIF to kind of really reach out to and see how can they serve the increasing needs of the HNIs, both for equities and fixed income.
Sure. Thank you, Bhavdeep. Those were some interesting insights with respect to markets and investors and clientele. That was all from today's session. Thank you for joining us.
Thank you for having.
Thank you.